The names of history's greatest investors often echo with a certain mystique, conjuring images of unparalleled success and seemingly effortless wealth creation. We hear of Buffett, of Graham, of figures who seem to have possessed a secret key to the market's vault. But what if the true power lies not in the individuals themselves, but in the enduring principles they so diligently applied? What if their genius was less about innate talent and more about a profound understanding of timeless truths? Beyond the headlines, beyond the individual stories, lies a deeper current of wisdom. These titans of finance didn't just make fortunes. They mastered the art of navigating uncertainty, of finding solid ground in shifting sands. Their consistent outperformance wasn't a matter of luck or fleeting market fads. It was the result of rigorous, disciplined thinking, a framework built on principles that remain as potent today as they were decades ago. Benjamin Graham, in his seminal work, The Intelligent Investor, reminded us that the investor's primary task is not to outperform the market, but to perform adequately in it. For the greatest, however, adequately meant consistently applying a framework that guaranteed long-term success. It was about building a foundation so robust that market volatility became a mere ripple, not a tidal wave. This journey isn't about chasing the latest trend or blindly imitating past successes. It's about internalizing a data-driven mindset, a critical approach to value that transcends any single market cycle. We are here to unearth these enduring principles, to dissect the core strategies that allowed history's greatest investors to consistently outperform. We will explore how they looked beyond the noise, how they found the signal within the chaos, and how their wisdom can fundamentally shape your own future in the world of investing. What truths did they uncover that remain hidden from so many today? The first, and perhaps most unshakable, lesson from history's greatest investors is the unwavering commitment to value. It's a principle that transcends market cycles, individual stock picks, and the cacophony of daily financial news. At its core, this isn't about predicting the short-term gyrations of stock prices. It's about understanding that a stock represents not just a ticker symbol, but an ownership stake in a genuine business. Investors like Warren Buffett and Charlie Munger, deeply influenced by Benjamin Graham, viewed the market as a place to acquire pieces of real economic engines. Think of it like buying a house. Do you purchase it based on the speculative price it might fetch tomorrow, or on its fundamental worth? Do you consider its rental income potential, the quality of its construction, the long-term prospects of its neighborhood? Value investing is precisely this, acquiring a dollar's worth of assets and earning power for 50 cents. It's about buying a business with sound fundamentals at a price that offers a significant cushion against error. The notion that value investing is dead is a persistent myth, often born from a confusion between simply cheap stocks and truly undervalued businesses. A stock can be cheap for a reason. Perhaps its business is deteriorating, its competitive advantage is eroding, or its industry is in secular decline. These are value traps, and they are the graveyard of many an investor's portfolio. True value lies in identifying businesses with enduring competitive advantages, strong earning power, and predictable free cash flows, all trading at a discount to their intrinsic worth. Developing a framework for estimating this intrinsic value is crucial. It requires looking beyond superficial metrics like the price-to-earnings ratio alone. Instead, focus on the business itself, its ability to generate consistent free cash flow, its competitive moat, and the quality of its management. Ask yourself, what is this business truly worth? And crucially, am I buying it with a substantial margin of safety? This margin of safety is your shield against the inevitable uncertainties of the market. As Benjamin Graham wisely stated, the investor who believes a stock is safe simply because its price has fallen is already succumbing to a speculative disease. True safety and true opportunity lies in disciplined valuation. The market, in its outward appearance, can seem like a tempestuous sea, tossed about by unpredictable waves of news and sentiment. But for those who have studied history's greatest investors, this volatility is often understood as an illusion, a reflection of human emotion rather than fundamental economic shifts. The true masters don't fight the storm. They understand its nature and build their vessels to withstand it. Their greatest defense is not against the market, but against their own internal turbulence. Consider a seasoned sailor navigating a powerful storm. They don't try to wrestle with the waves. They understand their immense power, they anticipate their patterns, and they skillfully use the very wind that threatens them to their advantage. Great investors do the same with market fear and greed. They recognize these powerful human emotions are not external forces to be battled, but predictable currents to be understood and managed. The fear of missing out, or FOMO, and the acute pain of loss are potent cognitive biases that can derail even the most rational investor. These emotional drivers often lead to impulsive decisions, buying at market tops out of exuberance or selling at market bottoms out of panic. Even figures like Jesse Livermore, a legendary speculator, despite a career marked by immense success and equally dramatic downturns, eventually learn learned the critical lesson of detaching emotion from analysis. His journey, though fraught with difficulty, underscores the necessity of emotional discipline. To cultivate this unflappability, implement a pre-mortem strategy before making any significant investment. Before committing capital, ask yourself what specific factors could go wrong with this investment, and more importantly, how might I emotionally react if those factors come to pass. Establish your predetermined exit strategy based on objective criteria, not on the spur of the moment panic or euphoria. This foresight acts as an emotional anchor. The market is indeed a pendulum, swinging between extremes of euphoria and despair. The truly wise investor learns to stand firm in the center, observing the swings without being swept away by either extreme. As Warren Buffett so eloquently puts it, we simply try to be fearful when others are greedy and greedy when others are fearful. This disciplined detachment is not a lack of conviction, but a profound understanding of human nature and its impact on markets. The allure of a single, brilliant trade, a market-beating coup, often blinds us to the most potent force in sustained wealth creation, the slow, steady, and relentless power of compounding. This isn't the stuff of overnight millionaire fantasies. It's the quiet, consistent architect of vast fortunes, a lesson frequently overlooked in our modern obsession with quick gains. History's greatest investors understood that true wealth is not a sprint, but a marathon built on the foundation of patience. Think of it like planting a seed. It doesn't transform into a mighty forest in a single day. It requires consistent watering, ample sunlight, and the passage of time. Compounding is that forest, built not from a single magnificent tree, but from countless small, reinvested gains that, over years, grow exponentially. Each reinvested dividend, each realized capital gain that is put back to work, acts as a new seed, contributing to the ever-expanding growth of your financial ecosystem. A common fallacy is the belief that one needs substantial capital to benefit from compounding. This is simply not true. Compounding works its magic on any sum, however modest, given sufficient time and consistent reinvestment. The true power lies not in the initial amount, but in the duration and the discipline of returning gains to the principal. We can see the dramatic impact of even small, regular contributions multiplied over decades, far outpacing sporadic, speculative ventures. To harness this power, practical application is key. Automate your investment contributions. Treat your investment transfers on payday as a non-negotiable expense, just like rent or utilities. The goal isn't to find the next hot stock that promises explosive returns. It's to consistently feed the compounding engine, increasing the frequency and amount of your contributions over time. Albert Einstein is famously quoted as calling compound interest the eighth wonder of the world. And indeed, those who understand it earn it, while those who don't inevitably pay it through lost opportunity. The lesson is starkly clear. Patience and consistency are not merely virtues. They are the true, fundamental engines of sustainable wealth creation. The journey through history's greatest investment minds reveals a consistent focus not just on identifying profitable businesses, but on finding those with enduring competitive advantages, what Warren Buffett famously termed economic moats. These moats are the invisible shields that protect a company's profitability from the relentless onslaught of competition, allowing them to thrive not just for a quarter or a year, but for decades. Imagine a medieval castle. Its strength isn't solely in its stone walls, but in the wide, deep moats surrounding it, a formidable barrier that keeps attackers at bay. Economic moats function similarly for businesses. They are the intangible assets, the powerful network effects, the sustainable cost advantages, or the strong brand loyalty that shield a company's profits from being eroded by rivals. Investing in companies without such moats is akin to building on sand. Competitors, driven by the same pursuit of profit, will inevitably chip away at margins, making sustained success a precarious endeavor. Consider the enduring dominance of companies like Coca-Cola, with its unparalleled brand recognition and global distribution network, or Google, with its dominant search engine and vast data ecosystem. These are businesses that have meticulously cultivated and defended their moats, ensuring their long-term value. Understanding the nature and durability of a company's moat is therefore paramount. When you analyze a company, the critical question becomes, what is its economic moat? And just as importantly, how durable is this moat? And is it widening or narrowing over time? Look for indicators such as deeply ingrained brand loyalty that transcends price, proprietary patents that create exclusivity, regulatory advantages that create barriers to entry, or a cost leadership position that competitors simply cannot match. Ultimately, the true investor is not merely seeking today's profits. They are seeking businesses that possess the inherent strength and resilience to remain profitable tomorrow and the day after. This requires a gaze that extends beyond the immediate quarterly report, delving into the strategic architecture of the business itself, understanding the forces that protect its long-term viability. The conventional wisdom often whispers about diversification, urging us to spread our investments widely, a notion sometimes referred to as the only free lunch in finance. Yet, a deeper examination of history's most exceptional investors reveals a different path, one of high conviction, concentrated bets placed only after exhaustive research. While broad diversification aims to mitigate risk, true wealth creation often stems from the courage to allocate significant capital to a select few opportunities where conviction is exceptionally high, and that conviction is firmly rooted in data. Consider a master chef. They don't simply toss every spice in the pantry into a single dish, hoping for the best. Instead, they meticulously select a few high-quality ingredients, understanding precisely how each will complement the others to create a harmonious and exquisite masterpiece. Concentrated investing, when done with rigorous research and deep understanding, is precisely this, making a few well-researched, high-conviction bets that have the potential for outsized returns. The myth that diversification means owning dozens or even hundreds of stocks often leads to what can only be called diversification. When portfolios become too broad, performance tends to become mediocre, mirroring the market average, and effective oversight becomes nearly impossible. Investors like Warren Buffett, who have built fortunes, did so not by owning a little bit of everything, but by concentrating their capital in businesses they understood intimately, businesses they could analyze with profound depth. This doesn't mean abandoning risk management. Instead, it means shifting the focus from spreading risk thinly across many assets to managing risk intelligently within a concentrated portfolio. The actionable strategy is to conduct deep, thorough research into a handful of companies possessing strong economic moats and clear intrinsic value. Understand their business models, their competitive landscapes, and their long-term prospects inside and out. Then allocate capital with conviction, grounded in that rigorous research. The ultimate goal is not to own a little bit of everything, but to own the best things. As Warren Buffett famously articulated, never invest in a business you cannot understand. This principle of intelligent concentration, backed by unwavering research and conviction, is a cornerstone of enduring investment success. We have journeyed together, exploring the bedrock principles that have guided history's greatest investors through the ever-shifting landscape of financial markets. We've seen that their success wasn't born from a crystal ball, but from a deep-seated understanding of fundamental truths. We began with the unshakable foundation of value, recognizing that a stock is an ownership stake in a business, not merely a fluctuating ticker. We then navigated the treacherous waters of market psychology, understanding that mastering our own emotional responses is as critical as mastering market analysis. The patient, relentless power of compounding was revealed not as a passive force, but as an active engine of wealth, demanding consistency and time. We dissected the crucial concept of economic moats, the durable competitive advantages that shield businesses from rivals, ensuring their long-term profitability. And finally, we touched upon the wisdom of concentration, the power of conviction, but only when that conviction is forged in the fires of deep, data-driven research. These are not mere historical anecdotes or abstract theories. They are battle-tested principles, a robust framework forged in the crucible of decades, offering a clear path for navigating today's complex and often noisy markets. Benjamin Graham, the father of value investing, wisely stated, "The stock market is a voting machine in the short run, but a weighing machine in the long run." Our unwavering focus must always be on that weighing machine, on fundamental, data-driven truth, on the intrinsic worth that transcends the fleeting opinions of the crowd. The overarching lesson, the blueprint woven through the lives and strategies of these titans, is profound in its simplicity. True investment success is not a matter of luck, nor is it found in the elusive art of market timing. It is about cultivating a disciplined, analytical, and patient mindset. It is about the diligent application of these timeless principles. By consistently integrating these lessons into your own investment philosophy, you will not only build wealth, but you will cultivate something far more valuable: enduring financial resilience. The future of your financial journey is not predetermined by the market. It is shaped by the wisdom you choose to embrace and the discipline with which you apply it. What will be your first step in integrating these enduring principles into your own approach?